over my trade setup, how it works. I'll try and do a very entry level skim over the details, and then kind of work towards some more in-depth stuff towards the end to try and help you learn as you go. So right here is going to be an example of a winning trade that happened on Wednesday the 15th of January 2025. Looking at this, we're going to hover over on the 1 hour chart, the 8 o'clock candle. So any liquidity that we're looking for needs to be above or below that 8 o'clock candle. We're looking for liquidity to be taken during market hours. So if I am looking here to be mid premium, it'd be something like this high right here, or say this high right here. And then if we were going to go long, we need the price to be in a discount. So this would be a swing low that we could look at for some liquidity. So if I draw out my 50% mark here, again, the reason that we're doing this, if we look here, prices lower high, 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 and lower lows all the way down, right? So kind of think about it like this. People draw trend lines, and I really don't believe that those are any good. They just kind of give you like a thought of what it's going to do without really having any justification. But if you go like this, it'll kind of show you when it breaks higher and starts taking out these lower highs and making higher highs instead, right here. Then that tells you that you have a new leg of price that's being made. So that would be why I'm anchoring it to this high right here, because it's breaking all of these levels. And then I'm anchoring it to this low because it's doing the opposite thing. It's doing lower lows, lower lows, lower lows, and it's breaking these lower highs on the way down. So that's what gives me the ability to put this 50% mark on there. And so that's what I'm doing when I'm drawing that out. And then I'm looking for short positions anywhere in a premium. And premium is the 50% mark or higher. And then a discount is 50% mark or lower. And so it's kind of like the run's already done. So don't be looking for a short while you're in the bottom half of this range. And the long is already done if you're in the top half of this range. The price likes to ebb towards the equilibrium or the 50% mark. You'll see it come back time and time again as it kind of breaks in and out. It'll always kind of retrace or hang up in this 50% mark here. So that's why you want to be going short when you're in a premium, because your price is going to want to be pulled towards the middle, and long and a discount because the price is going to want to be pulled towards the middle that way. So we draw out these levels that price can get to during the 9:30 to 11:30 time frame. So that's why I drew this out here. I really never was expecting it to get to this low, but I was expecting it to get to these highs right here. So when we have price breaking the levels right here, this is a 1 minute chart, so this shows you a way zoomed in view of this chart. It'll show what the candles look like when they were actually breaking those levels there. So again, there's stop orders right up here. And so once those stop orders get filled, we're anticipating this is going to go short. So what we're looking for when we go short is we're looking for a fair value gap going down. And with that fair value gap, we need a shift in market structure. So a shift in market structure is any time that a lower low is broken in this instance. So when price drops below this swing low right here, it's a shift in market structure. The reason that it's a shift in market structure is because previously price was going up, right? So we're making lower highs or higher highs and higher lows all the way up here. And then when we make a low that is lower than this one, it means our direction has changed. So when our direction changes, then we're anticipating that's a really good indicator that a fair value gap going down would be accurate. So what we're going to look for here is we're going to look for a fair value gap going down that is going to give us an optimal entry. So we'll get rid of this here. And so the shift in market structure needs to be accompanied in the 3 candles that make up the fair value gap. So again, the fair value gap is 3 candles, 1, 2, 3, and the displacement where there is no overlap right here is the fair value gap. And now we're looking for a short fair value gap. This is a long fair value gap because the candles are going up. So we don't want to be taking an up gap when we're anticipating price to go down. So I'm going to draw out here the first short gap that gets made, and this one's kind of small, but if you look at it, I'll kind of zoom it back in here for you. You have this little gap here, and what are these 3 candles doing? They're breaking this low right here. So that is your shift in market structure. That's what's giving you the upper edge when you're compiling all these things. You're in a premium, so price wants to go towards what? Equilibrium. So that's pulling you down towards the middle, down. And then you have a fair value gap. That in itself is a PD array that makes price want to react off of that block. Now we have a shift in market structure. That's showing that price has a willingness to break below the lows that have been made. So that's again making it more bearish. And then in the next time that I break down this even further, I'll talk about how you can use higher time frame PD arrays to give you more of a sure feeling that you're doing the right thing, like fair value gaps on the 1 hour time frame that overlap. And sometimes you'll see that price bounces almost to the tick off of those things. So in this instance, we're looking to go short here. And so I put my trade entry at the bottom of this candle right here, or the bottom of the gap, the top of the 3rd candle. So that means that right here, that little blue line just puts you in the trade, and your loss on that trade at for the whole trade is 1 1/4 ticks. So that's hardly any risk whatsoever. Your stop should be up here. So that means that if price moves above this high, you think that price is going to continue higher, and then you're in a bad trade. So this is stopping your loss, and then you're out of the trade, you regroup, and you live to trade another day. But for the low, what we're looking for is going to be on the 1 hour chart. So we've gotten into a trade right here. Now we're expecting price to move down, but where do we expect price to go? Now we just had this giant move up at 8 o'clock. Do we expect that price is going to come all the way back down there? No, because they're going way into a discount. Remember, price is trying to go towards equilibrium. So you want the easiest fruit that you can get, the lowest hanging fruit. So I'm going to look at the 8 o'clock or 9 o'clock candle here, and I'm going to put a 50% mark on that. So that 50% mark should be a easy thing to shoot for where price is going to go. So if we draw this down to the 50% mark, a little further than that, the 50% line is right here. That means that price we're anticipating is going to move 109 handles, 109 and a half handles. And what does it do? It moves down there perfectly. So we have an entry here, and your maximum risk for this is 16 handles to win 109. So this number right here, the 6.84, that's telling you exactly how much more you're going to win than what you're going to lose. So you could take a losing trade framed like this 6.8 times before you would be in the negative if you win this trade just once. So 109 and 50. That ends up being $219 on one contract. $219 on one contract. And so let's say that you're trading with a leverage of 2 contracts on one account. That would mean that one trade would make you $438. That is 4 shifts at Walmart. Now let's say that you're trading with 5 accounts. So you have 5 prop firm accounts that you're paying $30 a month each for. So if you take 438 times 5, that's $21.90. So that's $2,190 on one trade. So that's basically 20 Walmart shifts, at least my Walmart shifts, because I'm part-time. But it's easy to see how fast that can scale up because, let's say you have 20 accounts, so that's 5 times that. That's $10,900. So it's these trades that you're looking for, and these trades don't happen every day. They happen once, maybe twice a week at the most. Sometimes they don't happen at all in a week. Sometimes they happen 3 times in a week. Sometimes it's more, sometimes it's less. You just have to be very disciplined to only be taking trades that are set up like this because they give you the highest reward possible, but it takes patience and it takes lots of effort. So I will explain the higher time frame PD arrays that help give you more of a reason to be going short in this particular example. Maybe in the next one, I'll tease it kind of right here and show you how this fair value gap right here, the price goes up to it. Look at how many times it just touches it and bounce off. Touches it, bounce off. Now, let's look at something even crazier. If we go and put a fib on here that shows you the 50 to 75% mark, usually it likes to flip around at the 50% mark, but it will go up to about the 66% mark or so, which is right in here, to the 75% mark. And this is a premium trade setup right here. That's a different kind of trade setup. But if you enter in on that kind of thing, that's also something that we can talk about in the future. So until next time, bye-bye.